Hey everybody, welcome back. Well, S&P 500 did drop today. Was it the crash we talked about yesterday? No, not really, but it was painful and it was something that we haven't seen in 20 years. Is this the start of a crash? No, I don't think so. Is this the start of a rotation? Yeah, I think there's some signs pointing to that, and I think we'll go through that. But I think we have to get the idea of, quote, crash out of our heads and start thinking about how we're going to make money from this and how we're going to profit. So let's talk about what the issue is, where the money's going, and how we can profit from it. So we're going to start with the basics. We're going to go through the rotation that we saw today, where the money went, why it's happening. Is this a one-day event? Is it not? There's a lot to dig into. Usually some of this I would say for Saturday. Make sure that you subscribe to this channel and click, because Saturday's video is going to be very in-depth with this topic. But I want you to at least have some semblance of what's going to happen tomorrow, what could happen tomorrow. Month over month came in at 0.1. Consensus 0.2, 3.3. We were looking for 3.4. Negative, this is what hurt us. 0.1, negative 0.1. I'll explain later. Now, the part I'll leave is this, the negative scaring people, the thing in deflationary. I'll start with that, but we'll get into what we're going to need to combat this with so that you have it for at least tomorrow. You need to see retail sales tick up because people are viewing this and they are concerned. They're saying deflationary. Yes and no. We can get into this later, but understand why what happened. We really need to drill into the sector so you can understand what's going on. And this is going to get in depth. Parts of this you're going to want to watch a couple times. Usually this level of in-depth I leave for a Saturday video. I'm going to cover some of it tonight, and the reason for that is because it's going to be actionable tomorrow. So there are parts of this, again, you might want to watch. Now, jobless claims should surprise people. 236, we were ticking up and up and up and up, and all of a sudden we're back to 222. This is just from, I believe it's Trading Economics. This is a free site. Anybody can use it. Bostic's speech, nobody cared. This is where it gets super interesting. So you have 527, 526, right? From before 528, 527, 5. And then you see the mortgage rates drop, right? What doesn't drop? The 30-year. So they're going to cut rates for sure. And we know they're going to cut rates. And now you can see right here, and they're going to do it in September. We'll get to that. But look at the 30-year bond. Now, I just want to show you what scared people. This negative right here, that scared everybody. And the reason that scared everybody is it's so much more contracting than anybody thought. So it's got people on a little bit of high alert. How do we combat this? People are going to look at retail sales numbers. We'll talk about the sectors that sold down and what we can do about it. But the last time you had this was the pandemic. You haven't seen anything like this since the pandemic. And before then, you rarely saw anything like this. So it scared people. That led to presumptive selling. Now in front of you is CME Fed tool. And this is just where you can go and see the probability of target of rates. This is September 18th. And what you're going to note is right here, it'll tell you, you're looking at a 92.7% chance. There's a 7.3% chance they leave it where we are. Why is this important? Because if you look a week ago, you had a 68.4 for one cut right here, because this is the current right here. The current target is right here. And if you look down here, then you would have gone to a 69 yesterday, and now you're at an 84.6. And the chances of 2 rate cuts went from 6 last week to 3.7 yesterday to 8 today. That's how strong this number was, this miss. PPI would have to come in super hot to even think of doing anything with this, meaning hot by higher than expected. And I don't foresee that happening. So based upon this, we saw weakness, and this is really interesting because it's very rare, but there's a couple reasons for it. Now, we know what the news is, and we're going to talk about the reaction to the news. So we do this publicly live pre-market. You can see the 1 minute bar here. We always mark off the 8:30 because that allows us to know where the inflection points are and what's happening in the market. By marking that off, if you're a futures trader and you're not marking this off, you're at a huge disadvantage. But you can see this very clearly. You were unable, once you got back in here, to ever get out of this. As a matter of fact, here's the 9 o'clock level. You see 9:30 and you're in limbo, tries to get to the top of it, Matumboed, and then you cracked it. And that was it. You never came back. Really significant to do this. And what this will do, and we'll show you how to look at this relative as well, but what this does is by marking off that 8:30 bar, where you could see when you had a problem. So you can see right here, right off the open, 9:32, you try to break it, and you're riding that low end of it. Undercut, tries to rally, can't again. Again, if you're a futures trader and you're not using this, you're at a huge disservice because anybody that did Had some really great entries on the short side today, and you can see how that played out. It played out very nicely. So why am I showing you this? Because it wasn't just that everything went down. Some actually went up. Now, if we look at small caps and the rotation that happened, you rallied straight up. You couldn't even get near it by 9:30 when the market finally opened. You have your retest right here at 9:42 of that level from 8:30, and then you just rip all day long, and now you have these new levels. And this is significant. Now, what you don't want to do is try to create and reinvent the wheel, but if you mark off the 8:30 and then you put the Russell on here, you put on the dollar for a demarcation line, the ES, S&P 500, you put the NASDAQ on, and then you just put yield on as well. You can see this is the 10-year, just the yield down here. Look at what's going on right there. This tells you everything you need to know. They're buying bonds. They're selling the dollar, which is really confusing because they're selling the dollar. And so people would think that equities then are going to rise, and they didn't. So the chances of this happening, this happened really once in 20 years, and I'm going to show you this in a second. But most important, it actually happened for a minute in a day in November in 2020 as well, but very briefly, but it was sustained 20 years ago. But what happened here was they bought small caps. They blew out of names and they bought small caps. My problem with thinking that this is sustainable is the fact that I'm thinking rotation. I thought rotation, meaning they're going to get out of the NASDAQ and they go here. No, what they're doing is they're not only rotating into small caps, and there's certain sectors that are going to outperform now unequivocally. It's not even subjective. It's very objective what's going to happen here with some of these sectors. But I was not thinking of the fact of, well, that they're going to just want to lock in profit because of this, because of how they're referring to that number as soft, and now they're worried about the consumer. So if you didn't catch this shift, or you didn't think this shift was going to be sustainable, you're in good company, because a lot of people didn't think that this was going to be sustainable, because it usually, guess what, is not sustainable. What's a little disconcerting to me about this is when this happened. So I'm just going to point this out. This is something that Goldman put out, and they're the people that highlighted this. So I just want to give credit where credit's due, but they're talking about the daily spread. So if I go here and look at this daily spread, and you can see right here, right? That's where you were, but you were there very briefly, but this is where you're at today. And then of course they're referring to back here. This was before the great financial crisis, and this was coming out of the pandemic. This led to an entire rip of the market, and this did not lead to a rip of the market, quite the contrary. I think it's a very interesting demarcation line where this happened today. And it makes you wonder, what's the impetus for this? Well, there's two impetuses. Let's go through the first one. So the very first thing that we have to know is that small caps are going to rally and that this is going to continue. That's not really, I don't really think that that's a subjective statement at this point. And we could look at this and say, well, you don't know that that's going to continue. No. But what we do know is that they do better when you're cutting rates, and they're going to cut rates. You don't have a print like that and not cut rates. It doesn't happen. So they're going to cut rates. It's why we saw the shift. That's unequivocal. Small caps are going to benefit from that. And then you would want to go, okay, well, what sectors are going to benefit? And I'm going to show you in great detail that in a moment on what actually happened. So it's not really debatable what happened and where the money flow went today and why it's probably going to be sustainable. But you're going to go into the regionals. And the reason that the Russell is going to be sustainable is 15.9% of it is regional banks. Now, there's a lot of regulatory stuff that's coming up that's going to benefit these banks as well. One of the trades that we did today, probably one of the better trades that we did today, frankly, was this DPST. And this is just a 3X trade, real simple trade. And it's just going to benefit greatly. This is just the 3X regional bank, and it just exploded all day, ripped up off the open and kept going. So it's not really up for debate that regional banks benefit greatly from this. And then we'd have to go to the next sector and say, well, who else is going to benefit from this? And it's going to be the REITs. Why? A lot of pressure on commercial real estate. Well, if you're cutting rates, that pressure goes away. It also makes their cap rates better. If their cap rates get better, meaning you're leasing for X, and that mortgage payment is Y, therefore Z is the cap rate. I'm just paraphrasing. Therefore, I can sell it for, Q, whatever that number might be. But that number goes up based upon that. So therefore, these have value. The book values of these companies will go up, and then the cycle will be complete again, 10 years from now. But to think that commercial real estate is going to hit some other big gloom and doom right now, no. Are there going to be blow-ups? Yes. Are they going to be systemic now? No. I think that is unequivocal at this point. I don't think it's even open for debate anymore. Because if you can get cheaper money, you don't have to worry about it. You have to worry about it, but you can get cheaper money. You can do it if you have cheaper money. So that's why XLRE is doing what it wants to do. And then you would go here and go home builders. Well, the one problem that the home builders had was that rates, people were waiting for rates to come down before they were going to buy. Well, if you take a look at the home builders today, you can see unequivocally, you are above the 55. I used a 12, a 22, and a 55. You should use what you're comfortable with. But rates, that's going to drive us, and that's going to keep us up here. Okay, so that explains the one side of the equation, why the Russell will outperform for a period of time. How long that'll be, intermittently, interday, I don't have a clue. And here's the answer. Nobody does. What I do know is that the Russell will become a place where people are going to put money again. These three sectors that I just went over, I am most certainly going to look at putting money into. Candidly, I already started today, and I will continue to. So that is the first part of what we saw today. You're always open to comment, but this really is very objective. If you don't agree with it, I'd actually like to hear why, because it's pretty clear what's going on in the 10-year. I mean, you completely, utterly imploded. What I found fascinating about all of it was this. Yield on the 30-year bond actually went up at 1 o'clock today. And I think that threw everybody for a loop. Why aren't they buying out the 30 years? Because they're going to buy the shorter term paper first. So they're buying the shorter term paper because they're not in a hurry to buy this. I find this really kind of fascinating. And why are you seeing that? Well, there's a couple reasons for this. Here's the spread on the 10-year. And you can see that is 421. Now, if you take a look at this and you go, here's the spread on the 2-year. And they always talk about this 210 spread. And here you are at 450. So if you go and take a look at the 2-year spread and the 10-year spread, and you realize that the 2-year shorter term paper, and then you look at that spread and what's happening to that spread here. See how the spread's declining? What people are concerned about here more than anything is that you're going to see some kind of recessionary environment based upon what you saw. And that's why we've had this spread between these two, this negative spread, which signifies that you could have a recession. All right, so now you understand what the issue is. You understand the sectors that are moving, and you need to understand this as well while we're on the topic. And if you're in the community, you already know this. This is something we started buying a while ago because I think it became pretty clear that they were going to eventually cut rates. Just when, we don't know. But TLT, TMF, these kinds of trades now, it's pretty much undeniable that bond prices will go higher in the long term. Does TMF work? I don't have a clue because I don't know if you're going to get the momentum. But to think that TLT is not going to be higher in a year right now, to me, is absolutely silly after today. Now, we know where the money's going, those sectors. Let's talk about why the money's coming out of where it is. Now, in front of you is a screenshot from a Bloomberg. And this one is just going to have a bunch of this stuff up here. You can see all the different tabs that are open for different sectors of GS. It stands for Goldman Sachs. All right, let's just go through this so that you can get this. These are election themes. I don't care about your politics, but understand that what you saw today is pretty much a no-brainer up here. I mean, tariff risk, they went up. The Democratic pair went up, and then I think the Republican pair went down. Who cares? But it's on here, onshore, offshore, high versus low. It's on the screen, so I'm going to point out what you're looking at. Most important is this. 1 day, 5 day, 1 month, year to date. 1 day, 5 day, 1 month, year to date. Stay with me with this because this is going to get pretty in depth and you're going to want to watch this part a couple times. So here's the AI baskets, and these are baskets on how Goldman looks at that whole sector. The power up group, meaning power up. What's power up? Utilities, like don't overthink it. Data centers, AI in general, AI PC upgrades, AI semis. Now, I've been breaking this down in our videos into two different categories, correct? I've been saying business and consumer, right? But really what I should be doing is telling you that this is the consumer and this is the business. And what you're going to see is that these got pummeled today. Okay, well, why? If rates drop, why? Okay, well, the first part of that is there's this talk, obviously, of the harder comps that you're going into for the AI names. We're not going to get into it all tonight. Some of it on Saturday. But you're having tougher comps. All right. But if we have a weak consumer, they're not doing all these upgrades. Therefore, this could be weaker. You're overexposed right now because of where the RSI is. And that's why you were suspect if something like this happened. It's why even yesterday's video, I talked about it. Hey, we could actually see a correction after this. I personally thought the correction would happen if we had a hotter number. The number was so weak that it scared people. And they dug into it line by line. I've looked at some of the stuff line by line. I'm not going to bore you with it, but I did it after the market, and I understand why they have some concerns. We'll address some of that on Saturday. But this is the point of the video that you want to pay attention to. Biotech, housing, liquid regional, commercial real estate, low profit R2K, nonprofit tech. Okay, nonprofit tech will go up. Why? Because they get to borrow money cheaper than they could before, okay? So if you want to take one thing from this video and you're like, thank God he got to a point, but there's a lot of points in here, but you're looking for the easy point, it's right here. Start looking at these right here. This is what you want to focus on. Now, this is where the nerd in me gets super interested, because this is hedge fund VIP sectors. Like, picture all the top names that the hedge funds own, and then picture all the pigs that everybody shorts. If you did them as a pair trade and you went long the VIP names and short the most shorted names, you lost 3.6% today. If you bought all the high growth, high margin names and you shorted all the low margin names, you lost 3.8. If you bought, this was very important, if you bought all the mega cap tech names and then you shorted all non-profitable tech, you lost 6.6%. What was the worst performing sector today? Mega cap tech. We're going to get into why. But I think this part's also important, because not only that, but you want to break it down into things. So did high quality matter? No, they sold high quality. Momentum X meme names. Meme names had momentum do. They sold momentum. They sold high beta momentum. Did they sell large or did they sell small? They sold large cap, high beta momentum names of high quality. It doesn't get any clearer, guys. This is objective. This is not open for debate. This is what happened today. Now, if you understand that things are getting weaker for the consumer and that means that you could hit more of a recessionary type of period, you have to think about where do you have your money. And so here you have the momentum names had the best first half of our record, potentially leaving room for normalization of sector tailwinds that aren't sustained. Secular tailwinds that aren't sustained. In other words, you're going to revert to a mean. So if you take this right here and they tell you 2024, and you go, this goes all the way to 13, 14, 15, right? And each one of these is color coded by that time frame. And then they put them here and they go, okay, here's your January start date, go. How did you do from January to July? And then they're showing you. What they're showing you is that this Momo sector right here had the best first half on record, leaving room for a normalization if secular tailwinds aren't sustained. Reversion to the mean. Okay, so the majority are between 90 and 109, and you're at 135. So what they're saying is, if this doesn't get a hold of itself, that this is the amount of risk that that sector has. Well, if you're a hedge fund and you know this, or you're a long-only fund and you know that historically this is how far you are off any reversion to a mean, you're going to be concerned because you think that the consumer's weak. Now, momentum exposure to the book. So if you looked at all the hedge funds and you said, well, how much exposure do you really have out there? Medium-term exposure to momentum. And then you would say, well, this is systemic versus fundamental. Okay, well, let's just say on an average basis, how much exposure do we have to momentum stocks in hedge funds right now? And you take the top of this on 24, because that's where we are right now, and you would draw a line. And you would say, okay, well, that looks like we have above average fundamental long-short exposure there. So fundamental analysis exposure long short is above average. So that puts momentum at risk on the fundamental long short side. Systematic risk up here. And then you would look right here and go, okay, well, here. Yeah, that's a problem. Okay, because now you would say that the majority of people, medium-term momentum exposure is in the 90 percentile, which is way over anything that we've seen before on the Momo side, and it takes you to the peak where we corrected, and it takes you back here as well, and here we are again, and therefore we're seeing a little bit of pressure. Now, visualize for a second that you're a hedge fund and you're having a great year, and where's your performance coming from? Well, it's coming from all these medium-term momentum names that crushed it and were outperforming. Okay, how much is that attributing to your performance? Well, on the fundamental side, if you were to look between 23 and 24, you would say it's at all-time highs on the fundamental side. of your performance. How about if you were just systematically trading it? Yeah, it's a huge position. So all your gains are in those medium-term momentum names, and you have the most exposure there. Do you see the issue? And then what you'd want to do is you'd want to say to yourself, well, maybe not everybody's in this trade. And then you'd go, okay, well, this shows trade crowdedness. And then you'd say to yourself, well, let's see, on average, okay, well, that's definitely above average. So over the past 4 years, would you say that if you were to average that together, is that high or low? Well, that's high. You were higher here as far as being in a trade crowd, right? But right now, you'd still have to say you're still pretty high. So you have all these names that everybody's in, and everyone got a piece of data that no one was expecting today. Remember when I showed data yesterday, we showed the CPI data, and we showed you had 66 analysts out there. The lowest number of all 66 analysts was 0.1. 0.1% was the lowest analyst on record, and you came in at negative 0.1. So it was weaker than expected, and it did lead to more selling than I anticipated. So then okay, everybody's in these momentum names. The majority of people trade crowdedness, they're in this. The majority of their profits for the year are in this, and momentum names over the past 10 years are outperforming greater than they ever have. Well, no wonder the Russell went up the way it did. Everybody's looking for places to put new capital. And that's why you're going to see follow through in those sectors. I don't think this is a one-day event, and I'm going to show you why. If you look at the returns from 23 versus 24 in the first half of the year, thematic returns, we'll get into other returns in a second, and you said, okay, here's 23 on the full year, and here's 24 on the full year. Here's mega cap tech at 45%. Then you have the obesity drugs. Then you have Power Up America. So what are you seeing here? Okay, you're seeing very clearly that right now, mega cap tech, AI PC and mobile device upgrades, the obesity drugs, and AI power, everything up here is the most at risk. Why? Because that is where you have your returns from 24, and you could go out here from 23, which is going to split you this way, right? And so if you look at it from there, you would go, okay, well, the power up story might not have the same issue, but these are in your crosshairs. And that's what you'd have to focus on. You don't care about new tech or the meme names from 23 because you have to think about 24 as well. So if you take that crosshair, again, you'd put it here and you'd look at what's most at risk. These are going to be most at risk. And then you would go to 23 and just drop it to that 50% level and go, okay, these would also be at risk, right? All up here and then anything over. And that puts you in a really precarious position because now you know where the risk is. Now, you come into the market today, you see a nice CPI number, you're feeling pretty good about yourself, and then you're watching everybody start to sell your names. And then you start realizing that you have all this profit that you're up greater than you've been in 10 years. You killed it this year, and you're watching it go away because of this soft print. And that's why we saw this, XLY, do what it did. The biggest issue I have on days like today is the reversal. And this is just, it happens to everybody. Everyone has their thing. When you open up, rally, and then reverse like that, that's just nasty to do to people. It's just outright mean. But when you see this, they're marking tops. That's marking the top of a chart, okay? And why do they do this? Because they lured people in. It was no different than what they did with Apple today. I had a great long trade in Apple, if you can believe it. But what you're dealing with, because the skew's so great, we'll talk about the skew later, is literally when you're breaking down here, you're buying these breakdowns and you're selling these breakouts. You're going to get the momentum to get out of these names. That is going to happen. And I should comment on a couple things before I walk you through these charts. Now, while we're doing this, just friendly reminder, if you are on the wait list to get into the community, there's 48 hours left if you have gotten a letter, and you'll get an update on that later. If you're trying to get into the community, just get on the wait list, and then we will be sending another batch out shortly, and then it will be closed because I talk to everybody one-on-one if they want to that comes in. I want to show you the sectors real quick so that you can actually see in just your own sectors, XLRE, XLU, XLI. You want to focus on the short-term industrials, not long-term industrials, short-term industrials. Think Ingersoll Rand, IR, think TT, Train, those kinds of names, LII, Lennox, they're short-term industrials. Do you want me to explain why short-term industrials versus long-term? I can't. They just go up when this starts to happen and you have a weak kind of environment. And you can see what they're dumping, okay? See what they're buying. This is not something that's just going to change in a day. Unless you get like a super hot PPI tomorrow, and even then that would just raise more questions. If you're going to get into S&P industry groups, you're going to see household products, real estate, utilities. This is industry groups versus sectors, and you can see what they're dumping, okay? And I want to just get into this one piece because it resonates with what I said earlier. The growth picture has not changed, and this is just from an investment bank. You can see the opportunity to sell RIPs. All right, so what are they telling you to do? Sell RIPs. Like, they can't really be any clearer. Selectively in pockets, the market will begin to crack. As such, middle income consumer and high yield debt members, they want to get out of that. The negative headline prints, how weak is the underlying economy? This is the new question. This is going to bring back a recession narrative. This makes retail sales print next week more critical as a follow-up to CPI. That's what I was talking about earlier. The retail sales number next week is a big deal now, guys. See, this is why the stool is so important when you have these stools that I talk about all the time. And the reason that they're so important is because when you're looking at this stuff, you can go, oh, well, this is the macro leg and CPI is important. But then it changes, right? Then it becomes the fundamentals and technicals. But what on the macro leg you have to pay attention to, retail sales 2 months ago was okay. Now it's going to carry about as much weight as CPI. So that, it always moves. That's why when you understand how it's connected, it's important. As big as today's moves are, they hardly register in the long-term charts. This is very true. You hardly on the long-term chart are over on RTY versus the NASDAQ on a comparative basis. And this is also kind of interesting. The subtle narrative shift in AI, return on investment, combined with inflation normalization, changed to the status quo. So we wouldn't fade all of today's move just yet, though we remain bullish, consistent narratives, and cautious on cyclical generally. So basically what they're saying is, yeah, we like the ideas, and we're not telling you to fade everything, but you might have a couple little issues here. Perfectly orchestrated statement by anybody that is an economist. You really think about it, because you said a lot without saying anything. So what does that all mean? Bottom line is, what's price doing? They're selling. And you could see that with Apple. I'll show these in a moment. But if you take a look at Google and these names, right here, you just see it's pretty obvious what they're doing, right? So do you want to be that guy that's trying to catch this now when institutions, after everything I just showed and how they're getting out? It doesn't mean that you don't trade them, but understand what type of tailwind you're fighting. Even me trying to get up and in this name before earnings, because I really like Netflix, I have to really start looking at what I'm doing here and who am I really fighting now to get in these names. Look at what they're doing to NVIDIA. Just disclosure, I have puts in NVIDIA. But if you look here and how this is going, is anything about this look like you're seeing stabilization? No. I guess the robot taxi got halted. Now you're at 236 tonight. And I think, most likely you have to realize you're going to have Asia follow through, and then you're going to have Europe follow through. And so it's going to be pretty messy tomorrow, at least off the open. My hope is that it's like a flush and then we can reset up. But you have to look at this. Two other things I'm going to leave you with, and I apologize for Thursday for this being a long one. But if you're trying to figure out what to do here, FNGU is a FANG 3X. If you want to play the bull side and you're looking and going, I can't buy all 10 of these, just look at FNGU. It's all of these 3X'd out, and you can see how that's acting at the end of the day. It's imploding. And then you can see here at the end of the day, this is FNGD. And you got to realize that you're trading these things, guys. That's all you're doing with it. So, right, that's all you're really trying to do here. Look, covered a lot of ground tonight. That's it.